Good morning. This is Dylan Jovine with Behind the Markets. Happy Friday. Today is Friday, January 30th. TGIF. I'm excited. Not much planned this weekend. It's going to be cold for Florida. And the big thing for me is my 10-year-old Teddy has a basketball game. And team sports are so great for so many life lessons. And last year he was good on defense because I always say to my kids, do the job nobody else wants to do, the hard job, and really show your coach, work your way up. Really work for it. And last year, he didn't want the ball to shoot for offense, but this year he's really blossomed a bit. And now I see him getting open and putting his hand up and getting the ball. They're starting to dish the ball to him. So what a great way to grow as a person through sports. Anyway, BlackRock came out with a note yesterday actually saying investors can no longer rely on bonds for portfolio safety. That is a big deal. The world's largest asset manager, $13 trillion under management, is telling investors they can't rely on bonds for safety. What do they mean by that? They basically said, and I have some notes here, warned investors that bonds can no longer be relied upon as a stabilizing force in portfolios as rising debt levels and stubborn inflation pressure undermine the asset class's role as a traditional safe haven. And I have some notes. They're saying that recent volatility in the global bond markets underscore a structural shift driven by more government borrowing and higher for longer rates. What they're really saying is that bonds that are long-term, basically whenever rates go higher, we're borrowing so much debt that it's pushing rates higher. Or when there's a tariff threat, or trade policies that are aggressive, it's spiking rates, which is pushing bonds lower. Remember something, and we've talked about this a dozen times in the past few years. The longer duration a bond is, the more sensitive it is to interest rates, okay? So remember, when interest rates go up, bond prices go down, like a seesaw. When interest rates go down, bond prices go up. So what BlackRock is saying here is that we are entering a new era of higher for longer interest rates on long bonds, 20-year, 30-year bonds. That is going to have a significant seesaw impact on portfolios that are constructed that way. And for the past 30 years, the conventional wisdom on Wall Street, or 40 years, was the 60-40 portfolio. They're saying long bonds are no longer safe. And they actually, to put their money where their mouth is, the firm started reducing their exposure, it says here, to long-dated U.S. Treasuries since December 2025, just a month ago. And again, this has been a recurring theme for us here, longtime viewers of this channel and of our services Behind the Markets. We've been talking about this for a few years, basically saying that the massive amounts of debt that we are issuing, foreign buyers are not interested. They're not, and they're issuing their own debt. So you have the supply-demand problem. So what we're doing now is instead of really selling it to foreign buyers, we're buying it ourselves. We're printing money on, scales that have not been seen in peacetime, frankly. So we're printing so much money and we're buying so much of our own debt because there's weak demand out there. We're really keeping rates lower by doing that. And it says Jovine at BlackRock Investment Institute said, quote, "In this environment, bonds no longer provide the same level of portfolio ballast. Any spike in long-term bond yields can heighten debt sustainability concerns, repeatedly leading to a moderation of policy extremes over the past year." Politically, what he's saying is that whenever there's a tough political environment, slapping tariffs on this or Greenland that, what it does is it spikes bond yields, which sends the prices of the bonds down. Remember, it's the seesaw relationship. And then all of a sudden it moderates back when the policy gets normalized. For proof of this, look no further than the iShares 20-year Treasury Bond ETF. It has lost about 47% of its value over the past 5 years. And when adjusted for inflation, consumer prices have risen more than 25% during the same period of time. So the real purchasing power loss of that ETF is 70%. So it is massive, massive, massive. So what is an investor to do, especially if you're retired? What do? I'll tell you what I do with my money. I buy ETF short-term money market mutual funds, but they only invest in short-term U.S. government debt. That's it. 30-day, 60-day, 90-day debt. And you get 3.5% on your money, and it doesn't have as big of a seesaw effect because it's shorter duration stuff, shorter duration bonds that this money market mutual fund owns instead of long duration bonds. Remember, the longer the duration, the longer it takes for maturity to happen, the more volatile and sensitive it is to interest rate swings. The shorter the duration to maturity, the less volatile it is to interest rate swings. So that's what I do. And it's, it's something that it gives me flexible cash. If there are opportunities, the market pitches in my direction, I could sell those real quick and swing the bat. And it's also, Warren Buffett has become also the largest bond owner, and he's buying short-term debt too. And what it allows me to do is not basically hold long bonds at all, because I don't think they're paying enough for me to hold them. They're paying about a point above what I'm doing. So I'd rather not get 4.5% in long bonds, 20, 30-year bonds, with that volatility. Plus they're printing money. The Fed is suppressing interest rates. So I know that they're giving me a fixed repayment, a fixed dollar repayment on their coupons, but they're printing money to do it. So the fixed coupon they're giving me is worth less because of inflation, because I don't think it really measures inflation. I think the Fed is buying so much in the market, it's holding down. If the Fed was not buying this amount of bonds, interest rates would be higher, period, because it just isn't the demand for U.S. government bonds, long bonds, there has been before. And this is because presidents of both parties like to spend a lot of money, have been very fiscally irresponsible. Anyway, we had Trump's first term, 7.4 trillion in debt, Biden's term, 7.2 trillion, and it looks like we're going to add a similar amount in Trump's second term. So this is not a partisan issue. I'm not a partisan at all. This is bipartisan. It seems that the fiscal discipline that can't come from our governing politicians is coming from the market. So be careful. Anyway, that's all I have for you. Have a wonderful weekend, and I'll see you Monday.